Ladies and gentlemen, welcome to the Decentralized Real Estate Podcast, where we dive deep into the world of real estate investing. My name is Brendan, and I'm thrilled to be your host on this exciting journey. In each episode, we'll explore how blockchain technology and decentralization are reshaping the landscape of real estate and many other organizations, creating new opportunities for investors, developers, and communities alike. We'll uncover the latest trends, strategies, and success stories from industry leaders who are at the forefront of this transformative movement. From fractionalized ownership and tokenization of real estate assets to transparent governance and community-driven decision-making, we'll unravel the potential of this groundbreaking approach. Our goal is to inspire and educate you, our listeners, so you can navigate this evolving landscape with confidence and seize the immense possibilities it offers. So whether you're a seasoned real estate entrepreneur, a technology enthusiast, or simply curious about the future of the industry, join us in this podcast as we explore the centralized real estate revolution. Get ready for thought-provoking discussions, expert insights, and a glimpse into the exciting world of decentralized real estate. And with that, I'll pass it on to Isaiah, my co-host, to introduce our guest today, Frank.
Yeah, and on today's episode, we have Frank Hepworth, who is a friend, also advisor, who's a regulatory lawyer specializing in crypto regulations, and also founder of Verdue Regulatory, a law firm that helps crypto projects navigate the complex legal environment, who also has his own startup, I think, Yield School. But I'll let Frank introduce himself. Frank, if you want to introduce yourself to everyone listening today.
Sure. Thanks, guys. Happy to be on the podcast. Name is Frank. I'm a licensed attorney that has had a practice experience in regulation of crypto assets, primarily Canadian law, but studying American regulatory law as it often guides Canadian policy decisions. Got into it ever since I first started practice. I got into it because I just loved crypto. I was into crypto before law school. And so as I was going through law school, I just knew I was going to be practicing in the industry. And so when I entered the industry with a leading legal practice in Canada, we worked with platforms, exchanges, marketplaces that were integrating cryptocurrency or crypto assets into their business model in some way. And then we helped them with their regulatory compliance. And I did that for 2.5 years. I am stepping back from the legal role now, focusing more on that startup Yield School. But we focus on, we can't sort of drop the legal thing. So we're always involved.
Wonderful. Yeah, sounds like a really exciting journey so far. And, we're excited to be kind of step in step with you on, your entrepreneurship journey and starting up Yield School. So hoping this podcast finds many of your new potential members.
Yeah, 100%.
Awesome. Isaiah, what is the first question you have for Frank?
Yeah, I guess it goes hand in hand with what you said. You said you got into cryptocurrencies before you started law school. So what sort of was that first thing that piqued your interest? Do you remember that exact moment or sort of remember what sort of piqued your interest and curiosity?
Yeah, I wasn't that interested in it, but I'm Canadian and I was in Hong Kong and I made a bet on the Super Bowl with an American and he bet against Brady. This was in 2017. And so at the end of the game, he owed me 100 US, but I didn't have Venmo and he didn't have e-transfer, which is Canada's version of Venmo. And so we're trying to go, like, how can we go from 100 US dollars, like to Hong Kong dollars to Canadian dollars? Like, do we really need to do all that? And so he just said, can I send you some Ether? And so I said, I don't know what that is, but definitely. And then I was hooked, sent me some Ether. So my first foray into crypto was self-custody, which I'm actually pretty proud of. Nice. And I was hooked from that, especially because after Hong Kong, did a lot of traveling, went around the world, different countries for work and school. And while I was going through 10 different fiat currencies, I always had this Ether on my phone that was fluctuating in price. And of course, it was in 2017, so it was fluctuating a lot. And it was just something that was really interesting to me. So it seemed something very, very different than the physical cash I had in my hand and different than the stocks I was investing in. So I was just hooked from that point on.
Yeah, no, it's revolutionary, right? There's not one central location or bank providing this currency, and it allows instant transfer across the globe. So, I think cross-border payments, as you call out, is one of the biggest applications of blockchain technology. So,
Yeah, it
Nice.
just was really different. It was just really different. It was like, it wasn't like stocks, it wasn't like cash, it was just something, it was like a third category. So that's what really
Yeah,
intrigued me.
yeah,
Yeah.
yeah. Definitely an alternative asset at that time.
But yeah, so you said you got involved in 2017, right? When you were in Hong Kong making a bet, you need $100. So you were sort of during that whole market craze at the peak of the top. So how did you feel? Did you get in at the top prior to the top? Do you mind walking us through sort of that roller coaster of emotions you probably felt with your $100 going to maybe 200 and then maybe
Yeah.
going back down to $100 real quick?
Yeah. Blood was pumping. Yeah, I didn't speculate with it. I just researched the crap out of it for years. And it was in 2019 where I had just done my diligence and I was like, okay, this is everything. And I just went all in at 2019, which was pretty good timing. And when that paid off, when no one was paying attention, but I was piling whatever cash I had left into that market, I was especially doubly hooked after that because I was able to call that correctly. And so it was some validation.
Very nice. Is that kind of what started, Yield School? And can you tell us a little bit more about Yield School?
Yield School, yeah, thanks for asking. Yield School is just, we show people who are casual crypto investors how to go deeper into it. So Coinbase has 110 million users. So it has a ton of people who are like, know that there's some good assets in the crypto markets, but there's a lot of them who want to go deeper. They want to go past Coinbase. They want to go like, they want to set up a MetaMask. They want to not just participate in like making passive yield, but they just want to get some of those assets before they're listed on Coinbase, but they don't know how to do it, or they don't want to waste the time like trying to figure it out on YouTube. And so we just have this membership group where we show them kind of the A to Z of going past the middleman and going to the back end decentralized markets. We say decentralized markets because with things like GameFi, we think DeFi is actually like decentralized finance, DeFi. We think that's too restrictive of a term. So we say decentralized markets because, for example, DRE, I probably wouldn't put into the DeFi category, but I would say that it would fall within it is definitely a market. There's definitely supply and demand. And so I would say it falls into a category of decentralized markets. And so we show people who are time constrained how to do that safely and profitably.
Nice.
That's what Yield School does. And I suppose just to give the context, the idea for that just came because I studied the regulations. Regulations are going to cause a split in the markets. Coinbase is only going to be able to offer a certain small chunk of assets, whereas there's this much larger back-end market that because of regulations, people in the West are always going to be restricted from in a convenient way. And so if you want to learn how to access it yourself, I saw there was a market opportunity there to show people like this is how you access that back-end market.
Nice. So you said a really good point about the regulations, how it might split the market kind of into the exchanges and the assets themselves. Can you expand a bit more on that?
Yeah. So I was touching on there that there's this split between the front end market and the back end market, right? And we can explain that from a regulatory viewpoint. We can categorize things as either assets or platforms that sell assets to the public. And regulations just restrict what type of assets can be sold to the public and what businesses are allowed to sell those assets to the public. And so we hear the term security a lot in crypto asset markets. No creator or issuer of a crypto asset wants their crypto asset to be considered a security by the regulators, because if it is, there's just a host of regulations and restrictions that apply to that crypto asset that typically the restrictions typically focus around how the asset is moved and who can own it and who can sell it. And because of those restrictions, the asset can't be used in the way that it was sort of designed to be used, because often they've been designed with some sort of function. So for example, you wouldn't be able to burn the crypto asset. A lot of crypto assets for a variety of reasons, are intended to be burned, destroyed, almost like they're a voucher or something to be used. But if it was considered as a security, there's no laws set up to account for that event. And so it's, just awkward and ugly. And so that's assets. And the other category is the platforms that sells securities or sells assets. And if you're going to offer assets or commodities to the retail public, you need to license that marketplace with regulators. So if you're going to sell a crypto asset to a US resident, you need to first register yourself with either the SEC or the CFTC in the United States. So like Uniswap should do that, PancakeSwap should do that, BitGet and Mexi Global, Binance, though Binance doesn't onboard US residents for that reason. So that's a bad example. But all the crypto exchanges that are run by people should be doing that, and they don't. And all the DeFi protocols that are arguably run by a team should be doing that, but don't. And so this has caused a split in the market because some assets and some platforms that sell assets are arguably compliant with the regulators, though very, very few, and even less than people think. As Chair Gensler of the SEC said, this industry is built on non-compliance. So in his opinion, pretty much the whole thing is legally non-compliant. But there's an argument like, say, Coinbase, maybe the assets that they offer are not securities. In their opinion, that's the case. The SEC seems to disagree. But Coinbase can't expand into the other 5,000 assets that are in the market. They can only offer the 250 assets that they have a strong argument that it is not a security, so they don't need to be regulated. And therefore, they're a marketplace that doesn't need to be regulated because they're not offering securities to the retail public. And so there's this split between the market where people who want the convenience, or people who like sign up for Coinbase and companies like Coinbase, they're going to have a selection just through an app on their phone of these assets that have an argument of not being a security. And so that's the front end market. And then there's this back end market where the assets are maybe securities, or in the regulator's opinion are definitely securities. And so Coinbase can't list them, but they nevertheless exist, and they're still accessible, and they're possibly good investments, and people still want to access them, but they're just not going to be able to do it through Coinbase. And so then they have to go to alternative means of access.
Interesting. Yeah, that's a lot of good points. Very insightful. Let's see, Isaiah, did you have a question on that?
Yeah, I did. And granted, you're from Canada, so you might have a little bit of a different, bringing up and sort of like viewpoint of cryptocurrencies. So based off of your knowledge and your expertise in the space, you had mentioned that there's a lot of it sounds like there's a lot of lack of regulatory clarity in the United States, but there seems to be regulatory clarity in other parts of the world. So how would you compare outside developing countries or outside countries compared to the US, and what's the benefit of their laws and the businesses building out there versus the laws here in the United States, or that of? What are the pros, what are the cons? Sort of, do you mind giving us a little outlook on outside countries versus the US?
Yeah. So I think that when people say there's a lack of regulatory clarity in the US, I get what they mean. But Chair Gensler, and I'm not, if I had to be on a team, I'm not in Chair Gensler's team, but I do agree with him that there's a big difference between regulations not being clear and you just not liking the regulations. I would say there's pretty good regulatory clarity in the US. It's just fundamentally incompatible with the way we want crypto assets to function. So that's just something that needs to get worked out. And if it doesn't work out and the existing regulatory regime is okay in the US, or like in the opinion of the regulators and the lawmakers, then crypto assets just aren't going to thrive in the US. in a regulated way. So that's just a pro-con discussion that the US government and lawmakers need to decide. As I point out to our yield school members, a big reason why the US is so hesitant is because it has this $100 trillion capital market that other economies don't have. And so if they do go and introduce custom regulation for these new assets, they could be really undermining their existing fantastic capital market that governs most of the world's assets. And so they should be extremely hesitant. Like, it's a completely rational thing. Crypto is very, very small, but other economies and countries don't have that cost benefit analysis to do. It's either onboard crypto or don't. There's not really much of a concern with undermining their existing capital markets, at least not to the same degree as the US. And so we see the EU trying hard with MiCA. MiCA, I think, is overhyped, for example. Like, so it really just focuses on companies like Coinbase. It makes a company like Coinbase easier to operate in the EU, and it allows them to list more assets than they would be allowed to in the US. And there is, generally speaking, more clarity around what type of assets could and could not be listed, and by consequence, what assets could and could not be sold to residents of the EU. But MiCA doesn't address the more difficult regulatory questions surrounding those back-end markets, those decentralized markets. So it doesn't really address what to do with Uniswap, and it doesn't really address what to do with a lot of NFTs. They've just sort of pushed that issue down the road because it's very difficult. Other jurisdictions like Dubai, I would say Vietnam as well, and South Korea are taking some interesting policy decisions. We just saw a South Korean court rule Luna as not a security from the Terra blockchain Luna, which is like pretty fascinating, actually. Of all assets that you would consider a security, like Luna would be, I would say it would be under US common law. But it's really great for crypto in that region for that court to decide it's not. So like, that's something interesting to look at. But Dubai is taking like an interesting approach, in my opinion. They're coming out with these regulations that are a little bit, they're custom, but they're a little bit, like, I would say, wishy-washy. And as long as you're willing to work with the Dubai regulators, I think they'll be very forgiving on pretty much anything you're intending. And if you want to try and describe your asset as like, oh, it's not a security, it's a utility token, or it's something that we should be able to use and offer freely to the public ex-US, I think those regulators are very forgiving of that interpretation. Whereas in the US, they wouldn't be very malleable with how they interpret those arguments. And so that's a big difference for sure.
Yeah, super interesting. I want to kind of go back to what you were talking about, U.S. regulations, $100 trillion capital markets. I think there's a lot of arguments there on maybe the good or bad of those markets, and certainly how they are, the effects globally of them. Do you have any, high-level policy prescriptions that you would think the U.S. would be, fond of, or not, maybe not fond, but smart to enact that would also foster the capital markets, but then also foster a thriving crypto market?
I would, if I was the US, I would continue with a wait and see approach. Actually, like, the approach they're taking makes sense to me, just because US capital market, it's a real powerhouse. It really is.
Certainly.
And so I would be hesitant to introduce regulations that could send things a little bit wonky just for the benefit of a growing asset class. Now, it is the fastest growing asset class in history. So like, that is a consideration, but I don't have any prescriptions. It's sort of the price you pay for having exclusive benefit of an industry for a century. It's like you have 100 years of radical financial benefit to your economy. And now, the cost of that is that when the competitor or potential competitor is introduced, you're going to be a little bit slow to adopt it, or very slow. or in last place, as it might happen to be. But there's a lot of money in the US, obviously. And so innovation follows the money. Like if you look at the VC funds for crypto assets, over 50% are US based. So US money is still getting into the industry. It's just perhaps not really benefiting the US public, but it's still US money getting involved. But the US money is going to be investing in, it's just going to be in the US, because of the regulations, it's just going to be a really uneven benefit from the growth of crypto asset markets, whereas in other economies, maybe there will be a more even distribution of just the appreciation of the crypto asset industry to between the people of those countries and the VC funds of those countries, the wealthier people of those countries.
Interesting. Yeah, the centralization of the benefits of decentralization. So it's a very interesting insight. Thank you.
Yeah, like it's just the accredited investor laws in the US and in Canada and in most Western states are just wonky, right? It just especially for crypto assets, because an argument in the US and that our regulators take is that we don't want you to invest in early stage companies or companies that haven't IPO'd, because you might be locked into that investment for a long period of time. Well, reason A is like you might get scammed. Reason B is that you might be locked into that investment for a long period of time. And so we're just going to reserve those investment opportunities for the class of investors who have the capital to maybe be locked into a long term of investment of 5 years or plus. And they say that those restrictions should also apply to a lot of crypto asset projects. But pretty much all crypto assets have like instant liquidity. Like you can always exit your crypto asset. There's liquidity everywhere. There's marketplaces for every crypto asset. So that argument doesn't really hold up. So like that's one example of something I would prescribe perhaps for the US regulatory regime, though it is just a nitpick rule, really. Just a note I wanted to put out there.
100%.
Okay, I did have one quick question. I know we're coming up on time here, and it's sort of like a hot topic. Granted, here in the United States, you mentioned it a couple times, $100 trillion market. So, what's sort of your outlook on the SEC versus Ripple case?
I don't have a strong opinion on this. I think it's very fascinating, though. Like, so when projects come to me asking for regulatory advice, it's usually, okay, your project is non-compliant according to SEC laws because they're looking to do something a lot more degen, a lot more out there than what you guys are doing. What you guys are doing is above board, and you've got the legal argument there, but a lot of other projects really don't. And so, okay, it's your project is non-compliant, but I understand if you want to go ahead and do it anyway, because right now all you need to do is weigh the risk reward. And the SEC is slow. They have many projects to pursue. And if it's taking them 3+ years to get Ripple sorted out, and mind you, Ripple is extremely well-funded because of the reason that they're getting sued for by the SEC. But if it's taking them that long to get Ripple sorted, they're not going to be able to munch through all the non-compliant projects out there. And furthermore, the SEC should be focusing on scams. Like there are downright theft, rug pull scam projects. And there's an argument whether they should be focusing on any of it and whether they should instead focus on markets that they regulate. So first, just to go on a detour, sometimes in decentralized markets, we'll see a rug pull happen, and then people go complain to the government saying, oh, this guy stole my money. It's like, well, if you want the protections of the law, maybe you should stick in regulated markets. Maybe you should stick on the stock exchange. And if you don't want those protections, or if you want the you can't have your cake and eat it too. Like if you want to participate in crypto, like true like types of projects that can rug pull you where you don't even know who the team is, there's like zero promises made, and then something goes wrong, and then you want to go to like the SEC and have them fix it for you. Like you can see where the SEC is coming from when they're like, okay, what do you want us to do here? Like you don't want to be regulated until it goes wrong, and then you want our regulation. It's people need to take some responsibility when they're presented with the opportunity. And so, but nevertheless, like if the SEC is going to be focusing on something, it should be on those projects that are making like direct misrepresentations and downright theft, as compared to like a legitimate project that is trying to do something legitimate, deliver a new service, a new product, a new protocol. But it just so happens that the crypto asset is available to members of the public, and now it's an unregistered security because the team is benefiting potentially if that asset appreciates. That's seems like a poor use of their time. I don't know if that answers the question, to be honest. I kind of went on a bit of a rant there.
It was a good rant. I think I'd like to ask a pointed question about, the regulatory environment for DAOs, decentralized organizations, and then maybe get your, opinion, as you kind of stated high level about DRE. We've talked about it, but give us the unfeathered, unaltered opinions.
DRE, you guys should be fine. Regulation of DAOs is just tricky. If you want legal protections in your DAO from liability, from member misconduct, the best protection you can get is then registering your DAO under some sort of corporate shell. But then as soon as you start to take those actions, it starts to lose the D in the DAO. And so then you have these considerations of now becoming a centralized financial company. And so you need to just problem solve in an uncharted territory. And that's why you guys are doing it, because that's what you're doing. There is no laid out path for a DAO and how to operate in a commercial environment. It's especially if you're trying to transverse like the two worlds. There are some projects that DRE can look to for guidance. So there are some other, we've talked about them, other sort of real estate ownership tokenization entities out there in the market, but they're centralized and they make huge concessions in their business model. So some will not sell to US residents, for example, because of the regulatory restriction on their business model. And not only that, they are non-compliant, because I know in the perspective of the regulators in the US, they're operating a marketplace that is unregistered. So even those entities, it's not like they've got it figured out. They're still totally in a gray area, but they're not scamming people, and the regulators will really only do something when a complaint comes in, generally speaking. And they're honest companies that just happen to be non-compliant with a certain aspect of their business model. And DRE is going to be potentially in the same area, but you guys are good dudes and a genuine service is being delivered. And if you're doing something crypto related, you're necessarily going to be in the gray, because this is an online economic structure that we don't have online economic regulations for. We only have regulations for real world economics that people are trying to awkwardly apply to online economics. So even though you guys are, because you guys are in like online economics, those regulations in the real world are going to be applied to you in an awkward way, but you're just going to have to take it as it comes and walk the path as best as you can. And that's why you're doing it, because if you walk that path, the opportunity is there.
Wonderful. Well said, Frank. Awesome. Well, I know that's coming close to our time. Is there anything you wanted to leave us off with?
Oh, nothing in particular. I just wish you guys the best of luck. Yeah, I'll be here for the journey, and just a bit of gratitude for having me on the podcast and being able to talk to you guys about DV at such like a foundational time for the project.
Yeah, 100%. Us as well. Thanks for joining. We're super excited about the future and, democratizing this big industry. So lots of work to do, lots of paths to walk precariously. So we'll definitely be talking.
Yeah, cool. Thank you guys.
Awesome. Thank you.